Welcome back to the What's Your One More podcast. In today's episode, I'm joined by one of my co-hosts, Mr. Daniel Halverson, as we address our March lending update. Daniel, thank you for being on the show as always.
Yeah, looking forward to it.
Yeah, man, it's great to have you here. And, and today's lending update, it comes with a lot of, I'm going to say it's honestly some kind of not favorable news in some aspects and some favorable news in some aspects. And, it's you can take the good with the bad in the lending world today. And this is kind of what we're going to talk about. Things happen, right? We've had some recent news where we've had, conventional loan limits increased, FHA loan limits increased, obviously VA loans increased. There's a lot of stuff that's kind of been really good news in the sense of, hey, man, things are kind of transitioning the right way. And then we get some kind of curveballs thrown at us here that take effect this month that are going to impact buyers any way you look at it. It's going to impact people that are looking to refinance any way you look at it. And that on the heels of what we're battling currently in the interest rate market as we wait on this roller coaster to kind of make that downward trend, that momentum we keep talking about, it could present some issues and affordability issues for some people as well. So let's start off with the good news because I always like that better. It's always great to lead with that. So let's start with some of the great news out of the FHA camp as well as the HUD camp in general as far as some of the updates they made.
Well, yeah, I'm a firm believer that you start with the good news and then just bury the bad news down at the end somewhere. See if people make it that far.
Address and deflect.
That's right.
Okay.
But, essentially on FHA loans, the mortgage insurance is paid monthly. It's actually calculated annually, but it's paid as monthly as part of the monthly payment. It's decreasing pretty much effective immediately by 30 basis points.
So let's just set the stage for the audience. With FHA loan, if you're buying an FHA loan, you're going to have what they call a monthly insurance premium. Some people call it the same thing as PMI. Essentially, the tool itself operates the same way, has a different name. So with FHA, you pay a funding fee that's included in your closing cost up front to HUD, and then you turn around, you have a monthly insurance fee that goes with it as well.
Correct.
And what we're talking about right now is that monthly insurance fee, which, really no matter what your credit score is the same number every single time, except on the conventional side, the PMI is dictated by your credit score. On the FHA side, it's come one, come all. Based on loan to value, this is what it's going to be, and this is the term that you're going to have it for. It's all preset no matter what your credit score is. It's all just based on how much down payment you put down with FHA, correct?
That is correct,
Okay,
yes.
So what we're talking about right now is this number has drastically gone backwards, which is good news.
100%, yeah.
So talk a little bit about the affordability impacts of that.
Well, and I think it's been 7 or 8 years since FHA made any changes to their mortgage insurance premiums.
Yeah, some time.
At that time, they actually had come down as well, but basically come down again by 30 basis points, and it's paid monthly as part of the borrower's monthly payment. But just an example to kind of illustrate what that means. If you take a $300,000 loan, a 30 basis point reduction in the monthly mortgage insurance equates to about $75 per month or $900 per year less that particular customer will pay in mortgage insurance. And, basically to take it a step further than that, that's on that loan amount, that's basically the equivalent of a 0.3% reduction in interest rate.
Wow.
So, as we're dealing with kind of the ebb and flow of mortgage rates, and unfortunately, month of February was not very kind to mortgage rates, which we'll talk a little bit about. But we are getting some positive news here that significantly improves affordability. Where even though we saw interest rates go up, from a monthly payment standpoint, a lot of that is offset on the FHA side with this news here. So, it's a big deal. So much that HUD estimates that, approximately 850,000 homeowners will benefit from those changes just this year alone.
Yeah.
So
let's talk a little bit about FHA. So for our audience, this is a big deal. And I would say about 35% of loans in America are FHA loans. About really 43% of all loans in America are Govy loans at this point. And those numbers aren't consistent. They change as rates go and they ebb and flow. I mean, obviously in 2020, it was more of like an 80-20, more conventionals than there were government loans. But the reason this happens, just to kind of point out, I think this is important, talk about why it happens. So that money that we're talking about, that monthly premium and that upfront premium, that is all paid directly to HUD. So the HUD gets the Housing and Urban Development. So they hold on to that money. And then what happens is as the default rates, and we did a whole episode on PMI and default rates and why you pay into this pool of insurance. Unlike conventional loans, government loans, once that premium is overfilled, they have to start essentially either using the money or basically buying down and rewarding future revenues coming in the form of PMI, which is what they're doing right here. They're actually reducing this. And to your point, 8 years ago they did this. They also did it again in 2000. Well, they did it earlier in 2009, and it's because they have too much money in the premium pool, meaning the default rates. This is further evidence when you hear about foreclosure waves and things that are happening. This is further evidence to support that the government's forecast and the government's current rate of foreclosures is not high, because they're not using this money. We all know that MIP and the PMI is used in foreclosure pools to support and offset the investors that buy into that. It's not actually happening, so they're actually having to reduce the premiums.
Yeah, exactly correct. I mean, what you said is pretty spot on. I mean, as delinquencies go down, generally speaking, affordability is improved. From the HUD side, FHA. Yeah. So you've got a market where delinquencies have been lower leading up to this, and as they continue to get more and more profitable, they pass that cost. They pass that savings along rather to the consumer. So this is really just a sign of lower delinquencies, HUD being healthy, having money in reserve, and then we see that savings be passed along to the consumer here. So
now, do you think this is a temporary savings, or do you think this is more of a long-term permanent savings?
Well, I mean, I guess leading in from what I just said, it was, I think 2015 was the last time they made a change to this.
Yeah.
So I don't think that they're certainly going to make changes in the future.
Sure.
But it's been 8 years since they made a change. It was 6 years before that, I believe, that they made a change. I'd have to go back and look at that. It's not something that they change frequently.
Yeah,
so.
that was my point. It's here for a little bit, and consistency. Anything longer than 3 years in the mortgage industry is a lifetime, right?
Absolutely.
So it looks like this could be here, history pending for a little while to come, and that's good news for our buyers.
Absolutely,
yeah.
Without a doubt.
So let's talk about the other side of HUD. There's really three sides. You got FHA, USDA, and they kind of fall into that same bucket there. Even though they're totally different products. But then there's the VA side of HUD. And so VA also made some changes. They announced a little earlier than FHA. So tell us about those for all of our veterans and retirees that are looking to take advantage of the VA loans.
Yeah. So essentially, similar to FHA, they call it an upfront mortgage insurance premium on FHA loans. But VA, they have a similar fee. It's called a funding fee. And essentially based on first-time use or subsequent use, that funding fee is a certain percentage. And effective April 7th, basically the Department of Veteran Affairs has lowered that funding fee anywhere from 15 to 30 basis points, depending on if it's first-time use versus subsequent use. And the way that benefits the borrower is that funding fee is rolled into their mortgage, generally speaking. Very, very select cases will someone want to pay that up front, but generally it's rolled into the loan. So it's not going to be anywhere near the same benefits to affordability of what FHA announced, but essentially, you're talking 15 to 30 basis points, which, could be $500, $600, $700 and could be well over that depending on loan amount. So it's just another opportunity where we're seeing some savings be passed along to the consumers here, which is welcome news. Before we kind of get into our next topic here at the very end, as far as interest rates are concerned. So, and those charts, if you go look at the actual lending update, that chart is updated there with the correct funding fees. So all that information is there based on basically first-time use, subsequent use, and then down payment amount will also impact what those funding fees are. But they went down across the board. Regardless of first-time use, subsequent use, or LTVs. So great news once again.
Yeah, and this is not a rather complicated chart that Daniel's referring to. There's a lot involved, though. So what we're going to do is we're going to put this in our show notes. There'll be a link in there where you can get to this lending update. There's about 2.5 pages of these charts you're referring to. And again, you don't have to be a loan expert to understand this. This is pretty simplified. I'm looking at it right now. You guys did a great job with it. So if you're a buyer, prospective buyer, or even an agent wants to know about these new funding fees, they're all going to be right here located in the show notes and on our YouTube channel as well. Click on those. You can find that 2 pages worth of charts that you've eloquently put together for us, Daniel. So thanks for doing that. But while you're taking a look at it, let's talk a little bit about, the digital world that we live in right now. There used to be a time when, you would ask someone to apply online or much less do a disclosure package online. And they would say, I don't feel comfortable putting my social security number online. I want to tell it to you over the phone. And, fast forward right to COVID. Now people don't even want to come in anymore. They would rather do it online. And in the spirit of that, you're starting to see the agencies, and when I say agencies, I mean Fannie Mae, Freddie Mac, HUD, they're all starting to move towards that digital progressive closing as well. We're not fully digital. There's a hybrid that you're getting ready to talk about. But man, this is kind of a nice concept that we're seeing really, it's been out for a little bit, but we're starting to see some adaptiveness to it. That's the thing about the mortgage business. There's always like a product that's front-led and it's not adapted by everybody. There's like one front runner and everybody wants to see what that front runner does. And they're like, is this going to work out? I don't know. Let them pave the way. We'll see how this goes. This product probably came out close to 2 years ago, but there wasn't a lot of adaptiveness to it. Now we're seeing it widely adapted, which I think has a lot of benefits to it. And so what I'm talking about is a digital closing versus going to your title company and doing a traditional closing. So I think you refer to this as a hybrid. You kind of want to explain that a little bit to our audience and what that means.
Yeah, and I think in general, the push for technology, obviously that goes across a lot of different industries, but in the mortgage world, I think that push towards digital really started with the front end loan origination side of things.
Yeah, completely.
And trying to streamline that from a technology standpoint to where it was more efficient, faster. And that doesn't always happen exactly as the technology folks would hope. But we're starting to see a much wider adoption of digital closings. And essentially, all that means is instead of going to typical title company, physically signing every single piece of paper, at this stage in the game, we can offer a hybrid closing where really anything that doesn't require a notarized signature can be digitally signed before closing.
Now, that's pretty impressive when you think about it, because most of the documents at closing do not require a notary, right? They don't require that. You're talking 80%?
I would say at least 80% of the documents.
Okay.
So, and the big win there for buyers, or if you're doing a refinance transaction, the big win there is instead of spending an hour at the title company, you could presumably spend 10 minutes, 15 minutes at the title company. So
does that mean the borrower's doing the heavy lifting prior to coming to closing?
No, not necessarily. I mean, a lot of what is being signed are mostly some of the administrative documents that I would say that most buyers probably are not super interested in reading and understanding. Yeah. Not to say that you get a digital copy of everything once you sign it. So not to say that you can't read those things, that you can't ask questions. Right,
but you're getting documents that's like, oh, hey, you got an appraisal. Need you to acknowledge you got an appraisal. It's like, yeah, I've signed that 4 times. I know I got the appraisal. Oh, hey, there's a privacy notice. We're not going to share your information. This is the 8th time I've signed this probably already. I mean, maybe not really 8, but you know what I mean. Like I've signed I know what a privacy policy is, right? But you still have to sign. It's like, initial, all bottom pages. So it's nice to have this ability to kind of wipe this out before you get there, right? To really kind of speed up that closing and maximize your time there.
Yeah, I mean, I think absolutely. And then the notarized signatures are the documents requiring notarized signatures are more so the ones that are more impactful that, somebody wants to make sure they understand. But hopefully by the time you're getting to the closing table, somebody really has a firm understanding of the type of loan they're getting, what their terms are going to look like.
Right.
You would like to think in most cases that somebody's not heavily reviewing the final disclosure to make sure they understand their loan terms.
Yeah.
So it's a great thing. We're working towards a fully digital closing later this year, at least, Bank of England, I can say that. And digital closings have been around for a while. I think that, this isn't, like you said, I mean, this is at least a couple of years that this has been available, but you've got some early adopters, but really a lot of investors that are buying mortgage-backed securities. They're buying loans after closing.
Yeah.
They've been reluctant to accept these just because it's kind of one of those fear of the unknown things where if everyone is not adopting it, then nobody wants to adopt it. So you're seeing more investors comfortable with this. The agencies are more comfortable with this.
Yeah, and there's some early things that had to come out of this that we've already seen have been corrected. But one of the early things was let's say you have spouses on a loan, right? Here was one of the major concerns. I have to send this to 2 different email addresses because I have to verify that in this case you and your spouse both signed this. Well, there was a fear that what if one spouse logged into another person's email? It's not uncommon to think you have access to that. And they signed the docs on their behalf. And then we go close, and then all of a sudden, the verification, wasn't significant enough, or they bypassed it. They close, and there's a default on the loan. And one spouse goes, "I never signed on that loan." So that's that early adaptiveness where you're like, I kind of want to see how this works out. What measures, what kind of 2-factor authentication do they have in place? I'm pretty sure when they come to the title company, as in this scenario, as a tandem, They both acknowledged they did the digital signings, so there's no questions there. But early on, these were kind of like almost like you're discovering how to do it for the first time. So I could kind of see the resistance that the industry may have had on that. But to your point, it's a state-by-state closing too, because there's some states that aren't going to allow for these full digital closings because the state's not prepared for it. I mean, we do have the mortgage electronic recording system with MERS, which has kind of been around for years. I want to say close to 18 years, but it has accelerated this process and helped it become more digital on the back end. But from a borrower's perspective, why is this important? There's a theology this can cut closing costs for you from a title company's perspective because you're reducing the amount of time the title company has to put into that closing. There's also a theology that, quite frankly, is probably going to eliminate some unnecessary positions when you're all going on a digital closing versus a more paper-driven closing. And then finally, this is called an E-note. So an E-note is real important because when you go to securitize a loan prior to digital closings, you literally had to take that physical paper that the borrower signed in the form of a note, send that to an intermediary or straight to the agency or the investor. They had to review it and then buy the paper. When you hear people say they buy the paper, that's actually what they're doing. They're buying the note. So they're owning that note. But in this case, it's a digital send. So all I just described is gone. It's a digital send and it's instantaneous from the title company right back to the bank to the investor. So it all happens in hours instead of days and weeks. And that speeds up the funding process and also speeds up the liquidity process of the industry. So this has a lot of benefits to both buyer and also lender/investor that we should probably see facilitate through the ranks of the mortgage industry over the next 3 years.
Yeah, as they work through the kinks, I think it's really going to be a very positive thing for the mortgage industry.
Yeah.
And just like most technologically driven, things, I think that the goal is cost. Can you reduce cost?
Sure.
Can you save time? Can you increase efficiency? So it's a great thing for borrowers. Less time spent at closing is always a good thing because we want as a mortgage lender, we want the closing experience to be very positive. It's the last thing that people remember. So if you can cut down on the time that they spend at closing, signing paperwork, you can really hopefully give them a more satisfactory closing process and increase the likelihood that, they have a positive experience.
Yeah. And the one thing I know about you is you love technology.
To an extent, at a very base level.
Yeah, so for you to bring this up, it must be pretty exciting and be worthwhile because if I know one thing about you, it's that how much you love technology. So let's jump into our final aspect of the lending update. And man, I feel like, again, at this point, we're all inflation experts. At this point, we're all Federal Reserve experts. At this point, we're all rate experts. But our last one was not another rate update, but here we are. It's a little humorous now because it's like, hey, man, I thought you said rates were getting lower and they're coming soon. And I love how you really just kind of addressed the white elephant in the room here because, we have been kind of on that train, if you may. They're coming. And I'm not saying we're not the boy that cried wolf here because we still believe that's going to happen. But like all things, sometimes progress takes a back step and then you go one step backwards to go 2 steps forwards. That's what happened here in February. And I'll let you kind of break it down. But you said earlier in the very beginning of this episode, we didn't get some favorable news in February. We're going to explain why that news was unfavorable and why we think it's temporary, very, very temporary. But nonetheless, we can't overlook the fact that things probably didn't go our way in January.
Yeah, without a doubt. I think that, a couple things really led to interest rates going up. The first one was jobs report came out much better than expected. And a little bit of that is smoke and mirrors. And listen, I don't claim to be the smartest guy in the room.
But let's talk about that.
But it seems to me that the jobs report that we got that was so favorable was all based on seasonal adjustments, meaning that these jobs weren't actually created. They're just seasonally adjusting the numbers. Mm-hmm. And once again, I'm sure that some of that has a purpose. I don't claim to be an expert on how those reports are made, but it would seem to me that the jobs report would simply measure the amount of jobs that were created, which is not necessarily the case of what happens here.
Well, can I interject a little bit here? We did a whole episode breaking down basically the state of the economy, and we talked a little bit in that episode about this job report and about this theology that so many jobs are being created. The seasonal adjustment aspect is a moving target, right? And so you're seasonally adjusting. Now, when we're doing job reports, we're looking in the rearview mirror for future predictions. That's a bold way of driving a car if you think about it. You can't drive it through the rearview mirror, but that's what's happening with some of these reports, such as this one. So seasonal adjustment is the holiday adjustment, right? Well, what kind of jobs are more affluent during the holiday than the rest of the season? It's part-time, right? So we had part-time jobs in there. the whole idea of part-time is that either A, they're temporary, which most of those were, so that means they're going to be removed, and B, they're part-time, so they're not full-time, which means they're probably working another job, right? So the reality is this job creation is kind of transposed of three different metrics. One, that first one I just described on there, seasonal holiday adjustments. Two, part-time, which means you're full-time somewhere else. And why are you part-time? Because of inflation, cost of living, cost of food, cost of shelter, cost of everything, energy. You can't afford to live with your normal rate, so you'll get a part-time job. And then the third one are all the people that are filing for new businesses. And that is probably the most biggest variable in this mark we can't equate for. And that's, hey, listen, Charlie, my producer, right, sitting over here right now, says, hey, listen, I'm a producer for What's Your One More, but I'm 1099. Charlie could open up a business right now titled Charlie Walker Producer LLC. And that's a new job created. But Charlie's a producer for Charlie. Charlie may not employ Daniel and Quentin in this case. Charlie employs Charlie, but that counts as a new job, and it counts as new job creations, and meaning he could create more jobs. He could, but the reality is that's what's going on with the gig economy right now. People are working from home. They're 1099. They're filing for new businesses, and they're employing themselves, right? And so the downside of that is you talk about these new jobs, but it's hard to keep up with those when they go when maybe they're not created anymore. Meaning that if you're a 1099 contract and you run out of contracts, you're not technically firing anybody and you're not technically laying anybody off. What are you going to do, lay yourself off? So the reality is you're not really accounting for the job creation and the job loss at the same time, which is, I'm not saying manipulating the reports. That's not what we're saying, but it's definitely smoke and mirrors in the reports. And I kind of want to go into that real briefly as we talk about why that job metric was showing the way it did and why we also think it's going to not correct itself, but the seasonality adjustment is going to go away.
Correct. Yeah. So essentially, job report was not favorable. We anticipate that actually, as we're recording tomorrow, job report, ADP job report gets released, and then Friday, I believe, the Bureau of Labor Statistics
BLS
releases theirs as well. So, we're anticipating more favorable. When we say more favorable, unfortunately, that means less job creations. But more favorable jobs report in this case for interest rates, because it's going to signify that the feds are succeeding in trying to slow the economy, which hopefully means less inflation, which means improvement for mortgage rates. So we're hopeful that we get good information there. And then, basically what happened in February with respect to inflation, we got a reading that met expectations on CPI. Came in at 0.5%, which met the expectation that 0.5 is ultimately what was expected. The year-to-year went down, but it went from 6.5% to 6.4% instead of what was being projected at 6.2%. If you look at the core CPI, it increased by 0.4% in January, which I believe was right in line with expectations. And although core CPI went down from 5.7 to 5.6%, once again, it was still higher than what the market was projecting. So the inflation data, I won't say it was incredibly unfavorable, but it wasn't what was expected. It was a little bit worse than what was expected. And that, coupled with the jobs report, sent this shock through the markets of, hey, the feds maybe are going to have to continue to be aggressive. Yep. Maybe what they're trying to accomplish is not happening at the speed that we were hoping that it would happen at. So you've got a lot of concern in the market right now when you combine, hey, tons more jobs, unemployment's going down, and inflation's not going down at the clip that we want it to. Okay, well, maybe we got some bigger concerns here, and really what happens anytime there's an inflation concern, that gets priced into interest rates. So we saw, a pretty considerable move to the negative in interest rates that really started with that job report and really kind of carried through the remainder of the month of February.
So to add some levity to that, we know that markets like certainty. They don't like uncertainty. So when uncertainty happens, we don't see favorable adjustments. When markets overreact, it's big. That's why it's called an overreaction. And they always overreact to the favor of the market, not the favor of the consumer. So we had some uncertainty with the job reports. Coupled with the uncertainty of the CPI report, it was a double whammy, right? And that's that momentum that you're talking about that didn't kind of go in our favor here. But, as we go through this, the CPI, we did a whole podcast on that as well. One of the things I noticed in there when you just said was the investors were pricing in fear that the Federal Reserve's maybe current strategy isn't working and that they're going to have to increase it. Well, we know that it takes about 90 days for whatever Fed hike that happens to work its way through the system, at minimum 90. Some argue it's 120, some argue it's up to 180, but at 90 days at minimum. If we go back 90 days, what happened? Well, we're starting to kind of backpedal the 75 basis points, and we started going downward with it, right? Down to 50. So what happens is there's a theology in the investor world that, oh crap, they may go back to 75. They may go back to that, and that's not what they want. They want another quarter hike, or maybe at best a 50 basis point hike. They do not want a 75 basis point hike. That would be that would definitely shock Wall Street. And so there's this concern though that if the 50 didn't work, well, that 25 definitely ain't going to work that they did. And as that shows up in the system, that's concerning. So there's this theology that, crap, here's the uncertainty. The Fed may jump in and overswing that pendulum right back again. And it'll be interesting to see. In 2 weeks, we'll get the Fed's notes. We'll get the Fed's open market committee, and we'll find out what they'll do. And you can bet we'll do a podcast on that. I mean, I think that all bets are off, but it'll be really interesting to see what they do. But if they increase it higher than 25 basis points, I think the market's pricing in 50 right now. I think that's what you're seeing. I think the investors are pricing in a 50, preparing for that. And so I don't think we'll see too much of a great shift if 50 happens. But if it's above that, that could lead to something.
Well, I think the good news too is that the Feds meet after the inflation data comes out.
Yes,
which is a big win. But in terms of our outlook on interest rates, we haven't changed our stance that we think that interest rates are going to go down. I want to be clear about that. And the reason we're saying that,
abundantly clear.
A number of reasons, but the biggest thing is, so if you look at the core CPI, so we're taking out food and energy costs, that is the Fed's preferred CPI reading here, because food and energy costs are more difficult to have an influence over. Those can be
That's correct. They're the most volatile. They can't control those.
Correct. So if you look at 43% of core CPI is shelter costs, and shelter costs were up 0.7% for the month of January and up 8% for the year.
For the audience, will you just take a brief moment to explain shelter costs? If this is a first-time listener, just explain shelter costs right out the gate. I know we've done it numerous times, but just take a minute to explain that.
Well, I mean, at the end of the day, it's the cost of housing. So is it costing more money? Are rents going up year over year? There's more that goes into it as well. But in terms of the primary thing that they're looking at in the core CPI, it is year over year change in apartment rent listings.
Right. You got apartment list rentings. That's one of the factors,
Yep.
and then the other one is the owner's equivalent of rent.
Correct.
Right.
So so if you look at really July 2021 is when shelter costs measured by apartment rent listings year over year really started to accelerate. So July started to take off. January 2022 was the peak of that. It was a little bit over 18%. So meaning year over year, the price people were paying for rent presumably was about 18% more based on the listings for apartment rentals.
Okay.
After that time, we saw, basically we got to the top of the mountain and then turn around and walk back down.
Right.
Basically, those shelter costs had been coming down in a straight line like a cliff from then until now, where they sit today at basically apartment rental, year over year, the change is about 3.3%. So you went from 18% to 3.3%. But the CPI is measured on a 12-month time frame. So
Right.
we have to let these higher months filter out in exchange for lower months.
Correct.
So that's why we still feel confident in that. If 43% of core CPI is shelter and shelter costs are going down, then logic would say that we can expect inflation to continue to come down based on how it's measured.
Yeah, and to your point, rental contracts aren't monthly; they're yearly.
Correct.
So we're measuring. We're not getting new rental contracts every single month to go, oh, here's the trend line. We're having to annualize that trend line, and so sometimes that takes time. And when do most contracts annualize? At the beginning of the year and mid-year. So summertime and January, right? Well, we just got January's information. So we're trying to, and that won't show up until February's reading. So we really won't get a read until this new contract information, to your point, until really this month. It'll be interesting to see how it shows up in shelter costs.
Without a doubt. Yeah. So you basically just got in February's announcement was January's inflation data. So you basically
Correct.
just got the highest shelter relief that you're going to get.
The highest.
So that's why we still feel that way, guys. And nothing happens in a straight line, unfortunately. even with COVID, when interest rates actually spiked pretty considerably before they came down.
Yeah.
And that was with the Fed intervening and buying mortgage-backed securities. So nothing happens in a straight line, really, in all walks of life. But especially when you're talking economic data, economic news that we're relying on when we say that mortgage rates are going to come down. So nothing has changed in our outlook. Would it have been nice if interest rates didn't go up in February and now we have to make up some ground? Absolutely. But we still feel strongly that as we move into the spring, that we're going to continue to see lower rates. And I'll leave, I guess, with parting thoughts here as it pertains to interest rates.
Okay.
So I was looking at something the other day Barry Habib had prepared, and he was talking about,
we're big Barry fans, by the way.
We most certainly are. Yeah. And if you're in the real estate or mortgage industry, and
you probably are too.
I have my doubts about you. But, he was talking about, basically why now is a good time to buy, despite the fact that interest rates just went up a little bit.
I love this. Is this little U shape he drew?
Yeah.
This is perfect.
And essentially he's talking about timing the bottom of the market, and nobody can time the bottom of the market. But he went all the way back to, actually early 2012 was when home prices hit their lowest. It wasn't, 08, 09. It was actually 2012 when they hit their lowest.
Right.
And then they increased considerably once they started to accelerate. They went up 8% year over year that first year, continued to accelerate. We had actually 121 straight months of home price appreciation. So from that time in 2012 until sometime in mid-2022, we had 121 straight months.
121.
Of higher home. That's 10 years for you guys counting home. But, basically at a decade of every single month, home prices went up.
Wow.
And, his point is when you're looking at timing the bottom right now, so nobody's ever going to time the bottom perfectly. But we know that we've gotten, 5-6 straight months of decelerating. Now home prices, maybe have taken a step backwards here.
In some parts of the country, yes.
Yeah, without a doubt. I think that, and we've talked about, a little bit of that with the list to sell price ratios and some of the other things we've talked about. But, you're looking at an opportunity here where you're very close to, and you're never going to know when you hit the bottom of the market until you're on the other side and it starts to accelerate. So you're never going to know when you've hit the bottom, but you're very close to it right now. And you look at, in 2012, before prices started to accelerate, there were 2.2 million homes nationwide available to buy inventory-wise. We've got 984,000 right now in this market with more people, and that doesn't even account for the homes that are under contract. So of those 984,000, some of them are under contract, so you can't buy those.
Yeah.
So we're very close to, if not at the bottom. And for those of you that are discouraged by interest rates, well, interest rates are going to come down, and what's ultimately going to happen that we continue to talk about, that we feel very strongly about, when interest rates come down, home prices are going to they're going to start to accelerate again.
Yeah, the seller's going to absorb that affordability.
There's not enough inventory.
Yep.
There's a lot of people that want to buy, and there's a lot of people waiting on interest rates to get back in the game.
100%.
So if you're a buyer right now, if you're a real estate professional, if you're a mortgage professional, you have to look at this as this is an opportunity for your customers to get in before prices start to accelerate. And if you can get into a home right now before prices accelerate, potentially refinance that home or use that ability to negotiate right now to get a 2-1 buy down, to get a long-term buy down, to negotiate a better deal with the potential upside of being able to refinance as well. This is still the prime opportunity, because if we're sitting here in May, June, July, and interest rates have come down considerably like we think that they may, you're probably talking multiple offers. You're probably talking no real ability to negotiate. You're probably talking maybe in some scenarios paying over list when you've got a home that's in a desirable area that's got a lot of competition. So this is your opportunity as a buyer right now, because in 3-4 months, this could look completely different and we could be having a completely different conversation.
Yeah, and I'm not even privy to the graphs you're looking at and the charts you're looking at, but what we'll do is we'll put those in the show notes as well so you guys can see, because I've seen what you're looking at. I just don't know if it's the same thing. But we'll put them in there from MBS Highway, and give credit over there to Barry's team for putting that together. It was wonderful. One of the things that I heard there, and here's an early sign of demand shift coming back, right? Here's an early sign, multiple offers. And in some markets, we're already seeing multiple offers on the desirable home at today's interest rates. So, if you're listening to this, the trend is already showing up currently. People are already understanding that dynamic play because, Daniel and Quentin, we're not the only people saying this right now. There's a lot of very educated, well-positioned individuals that are talking about this, and we're starting to see it show up. I think 2 weeks ago was the first sign of multiple offers that I had brought to my attention. And I was in an audience giving a talk, and I said, how many people are seeing multiple offers? 50% of the agents, they were real estate agents, raised their hand in the room, 50%. That was a big number to start to see that already come back, and that was in the month of February. And I'll leave with this. If you're a mortgage lender or you're a lender at any capacity, broker, mortgage lender, banker, there's two ways to look at this little bump in rates here. And I was talking to someone, I know you and I've had this conversation as well, and they're like, well, it would have been nice to see rates kind of, maintain that downward trend. We bumped back up. I go, yeah, but what the great news is? Your pipeline's not going anywhere because you're not getting back solicited on lower rates at this point. And for real estate agents, that's great too, because that means your borrower is going to stay where they're at. They're going to get closed, and then you don't have to worry about switching gears or switching lenders here at the last second because they got back solicited by someone for a lower rate. So March pipeline should close out very well, and here in the next coming weeks, you might even have an opportunity to lock in a lower rate for future pipelines in April and May. So there is a little bit of a win there. I think sometimes we all get lost on the idea of lower rates, push, but sometimes the downside of a roller coaster going down is that current pipeline is always subjective to either wanting to relock, which causes margin compression, or B, you have to switch lenders. And if you're a broker, you'd switch channels. So that is always a challenge that presents itself as lower rates start to drop on that roller coaster. And we're probably going to experience that between March and June at some capacity.
Yeah. I mean, everything you just said, you nailed it. I think that we've talked again and again about this being a great opportunity. I'm really hopeful that the conversation we have for the April lending update is the beginning signs of that. If we see some improvement in interest rates, we continue to move into the spring months. I really feel strongly that what we're saying right now, although it's maybe hard for a buyer to stomach that rates going from close to 6 to close to 7 signals a good opportunity to buy. I really feel strongly that if we can find a way to make the numbers work, if we can find a way to negotiate the offer to get the payment in line, that those people will look back 6, 8, 10, 12 months from now and say, man, really took advantage of a golden opportunity here. So that's really the big takeaway here. Nothing has changed with our rate outlook. Just a little bit more opportunity for buyers now than they had a few weeks ago. Yeah,
and depending on what philosophy you buy into here, Dan, for the people that are, I hear this from people that are huge Bitcoin followers all the time. The reason Bitcoin is going to take off at some capacity is because it's on the gold standard. And once it hits a certain number of 10, I think it's billion or I think it's 10 billion. Once it reaches a certain number, there's no more tokens that can be produced, therefore driving the demand. Well, take that same theology about housing here. Because you just mentioned there's 948,000 homes available. Once we get past that number, if new build can't keep up with the demand, you're going to be seeing certain housing shortage issues further really excel. And that's when the price of this stuff goes up. And that's when it goes up beyond believable status when you're like, I can't believe the home of the price is this. Well, because there's a shortage and someone's willing to pay that to have that home. And that is what's going to happen regardless of rates. We're either going to settle in at the current rate, we're going to get used to the current standards, or we're going to budget around that. There is a acclimation period that takes place. And once that takes place, look out. And heaven help us if those rates come back down and that acclimation period is already there. It's going to be a perfect storm of inventory going away and price points going up.
You're absolutely right.
Yeah. Dan, thanks for being on the show. As always, you always bring great information. Where can our listeners find more about you and Bank of England?
You can visit our website here at boejax.com. Give us a call at 904-992-1000, and we'd be happy to answer any questions that you have.
Yeah, and if you're not in Jacksonville and you're around the country, Daniel, I think you guys have branches all over the country. You can go to boemortgage.com. That's boemortgage.com. Check it out. There's great advisors all over the United States that can help you with that. I know we've got over 140 plus locations, and guys, you do a fantastic job. So thanks for being on the show and giving us some time this morning.
Yeah, thanks for having me.
Yeah, absolutely.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.